Hi guys, welcome to this month's webinar. So we're in a bit of a makeshift office today, so apologies for any glitches. We've moved office and we've just had to randomly set up computers in one office whilst our office is being all kitted out. So I hope everyone's well and looking forward to a nice Christmas break. What we're going to kind of run through today is a bit about sort of 2022, what's happened in 2022, our predictions, were they correct, were they not correct? We're going to start to edge into sort of 2023, what we expect to happen and what the plans are for 2023, how people can maximize their sort of their income and growth, and just give any sort of tips that we can. And of course, then we'll throw it over to you at the end and any questions that you've got. So without further ado, let me share my screen and we can start this webinar. So first things first is what I wanted to run through is a bit of a recap, what's happened in 2022. And as most of you are aware, it was like we support here, it's a year like no other. It was really a year of two halves. The way that the property market started off for the first 6 months is kind of a mirror opposite to what happened in the second 6 months of the year. We started off fantastic. We really continued in the same vein as what happened in 2021. We were seeing phenomenal growth year on year. In 2021, we saw 15–16% year on year in some areas. It was 1 to 2% increase every single month. We were seeing that the same at the start of 2022. Everyone was still thinking that it was a need for space. We did say that the need for space would be a bit of a fad, and it's proven to be correct. But the reality was people are still looking for that need for space. I think a lot of people thought that the work from home would have continued for a lot longer than it did. And I think what people didn't anticipate is the reality that work from home, people got a little bit tired of it. They wanted to get into the office. We started to see in Canary Wharf people coming back in on, Wednesdays and Thursdays, especially Thursdays, because that was typically a night out. Then it was Tuesday, Wednesday and Thursdays. And we're starting to see more people come back now on Mondays and Fridays. But half of that reason is because one is the social side. And another half, I think, is people actually are thinking, well, they can get their bills paid by work. So things like the heating and the electric, things like that. Actually, the reality is that working from home, you've got to heat your house at home, whereas now you're going to work and let work take care of that for you. But as I say, 2022 was a year of two halves. So as I said, the months 1 to 6, things were moving along nicely. But what did kick everything off was the Russian-Ukraine conflict. What we started to see was some shoots coming through of inflation. Now, we knew this was going to happen anyway. Now, this is something important to say as well. Inflation has always been in the background. The reality is that the US and the UK and a number of other countries as well, but more so US and UK, printed a huge amount of money. It's roughly about 40% of the wealth in the US was printed in the last couple of years. And it's about 20% in the UK. Now, when you think about that, you've had thousands of years of money, whether it was traded as silk before or pound notes as we know today, but 20% of people's wealth in the UK was created or has been created in the last 2 years. So there was bound to be inflation. Now, what we look at is there's there's a number of types of inflation, but what we look at, and we want to look beyond the inflation that you would see every sort of month or so in the newspapers, you look at core inflation. Now that's different. Core inflation is without the increased rise of energy and food. It's core inflation. Now that's what we look at, and that's actually a lot lower. It's tracking around about 6.5% at the moment. But the thing that kicked off the core inflation was the fact of just printing of money, especially during those COVID years. But then we, of course, had the conflict, the Russian conflict with Ukraine. Now, that then increased the inflation that we see now. It's caused havoc with energy. It's caused issues with food, because obviously a lot of grain comes out of Ukraine. So, of course, we've seen an increase in the food prices, an increase in energy prices, hence why we're seeing 10–11% inflation rates. And what did that do? Well, of course, that then kicked off to the second half of the year, where we started to see the Bank of England having to talk about increasing the rates. So, as I said, the fact that core inflation is, a lot lower, you're talking about 40% lower than what the inflation that we read every day in the papers is that gives me hope to think that once that starts to fall, the reality is the bank might start to decrease, and we can start to head back to where we, not probably where we were in terms of the 0.5% or the 0.75%, but we might be in the region of 1 to 1.5%. And we won't be looking at the 3% or potentially 3.5% is what's being predicted a bit later this month. So the second half of the year, as I say, we saw the mortgage rates increase. But core inflation, as I mentioned, is kind of what we're looking at and what we're focusing on, because that is what the Bank of England will look at as well. The need for space has fallen as well, whereas everybody in 2021 and start of 2022, everyone was looking for this need for space. Now that's dropped away dramatically. Now, why? Well, two main reasons is, first of all, we've noticed that a lot of people have said, well, they don't actually need the space anymore because they're going back to work. The second thing is, typically, if you have more space, it means that you're further away from a city centre, because that's typically where you get more bang for your buck. So again, people now need to be back closer towards city centres. And of course, something as well, which is important, is people are thinking now, well, actually, it costs a lot more to heat that bigger space. So what they're looking to do is say, well, actually, I don't need that bigger space anymore. I can actually do with a 1 or 2 bed apartment. I don't need that 3-bed house and only use one room of it. And it's actually quite interesting that the majority of apartments that we're selling at the moment are actually one bed apartments. So what we're saying to people is that the majority of apartments that we're selling are 1 bed, and the demand for 1 beds from a rental perspective is off the charts. We had for example, there was an apartment last 2 weeks ago. The tenant left on the Friday. We started advertising it on the previous Wednesday. By the following Tuesday, we've got someone in already. So it was only vacant for 3 days, and that's just because there is such demand. We could probably fill an apartment up with 10 to 15 tenants because there are so many applying for one particular apartment. So the need for space has definitively gone, and we're actually seeing a discount in prices. Whereas people overpaid for prices for a need for space, we're now seeing those prices discounted, and that's actually what's contributing to the fall that we have seen in the last couple of months. Also, as I said, the cost of living crisis here. So you've got smaller properties are now in vogue rather than that need for space. And the rental market, as I sort of briefly touched on there, the rental market is totally transformed in the last 12 months. The rental market was strong after COVID. We still had a lot of people looking for properties, but in the last 12 months, especially as people are saying, well, actually the affordability has gone out of the property market. One, because there was a price increase initially, and two, because obviously we've got an increased increased interest rates and mortgage rates. What people are saying now is they're going to rent for longer. So the rental market is increasing a huge percentage month on month. So that's something which is great for landlords. As I say, we're in a great opportunity. We're in a great business from our perspective. We're not looking for residential clients per se who will go in and buy. That's typically your Savills or your Bairstow-Eves, your Beresfords. We're in a position where investors and clients like yourself who are looking to invest can actually really take advantage of the opportunities that are out there. So that's kind of what happened in 2022. And really what spurred, is the mini budget, which really was the catalyst. It was kind of always there in the background. A lot of people are saying that's the sole reason. It wasn't. There was the inflation was always bubbling away in the background, but it was the mini budget that really just, started that push of the first domino, so to speak. So then we go on to our predictions, and were they right? Now, a lot yes, some no. We have to hold our hands up there. So look, let's look at what we did not get right. So first of all, interest rates. We did not expect them to be 3.5% at the end of this year. When we predicted them back in January of this year, we expect them to be anywhere between 1.25 to 1.5 maximum. We certainly didn't expect them to be 3.5%. I anticipated that there was going to be levels of core inflation of around about 4 to 5%. I didn't think it would reach 6%, 6.5%. And we certainly didn't foresee the Ukraine crisis, and of course, 10 to 11% inflation. Now that's what's dramatically changed the figures. I truly believe if we didn't have the Ukraine crisis, we would probably be around about the 1.5% by now. But I think that this extra inflation has made a lot of people nervous. So therefore, we're at 3% where we are, and potentially 3.5% by the end of the year. So interest rates, we were wrong. As I say, we predicted an increase, but maximum of 1.5%. But what did we get right? Now, it was quite important. We got COVID right. We got Brexit right. So I know Brexit is going back a bit, but it's still brought up in conversation today. A lot of people still think that Brexit is going to affect the property market. It's not. We didn't believe it at the time, and actually it spurred things on, and we certainly don't believe it now. We recently saw that a number of legislations and red tape lifted in the city because we can with Brexit, and that's spurring people on. A lot of people thought that Paris and Frankfurt would become the financial hub. They haven't. A lot of schools in Frankfurt were actually starting to open and cater for the influx of English that they thought was going to happen after Brexit. Again, it didn't. People just remained where they were and the status quo continued. So we got Brexit right. We then moved on to COVID. Everyone was predicting a 15 to a 30% fall, which was ridiculous. Bank of England saying there's going to be a 30% fall. It didn't happen. It went the other way. We're probably talking about a 25% rise on a lot of areas since COVID. And again, you can look back on our website. It's not something we're making up now. You can look back on our website. We've done blogs about this. We've done webinars about this. Head to our webinar in May 2020, and we actually predicted that the prices were going to increase quite dramatically over the next 12 to 18 months. And we also said at the same time, city centre living, it's so important that we don't follow fashions. And again, that's what a lot of amateur investors do, whether it's fashions in where to invest, whether it's fashions about when to buy, when not to buy. You know, you take an amateur investor, they would have had a roller coaster over the last 5 years. They would have not bought during Brexit because they would have read the latest news. They would have not bought during COVID because they would have read negative news. That's what an amateur investor does. They look at the here and now. They don't look at the long term. So they wouldn't have bought during Brexit or COVID. And then when they would have purchased, is they would have purchased when all the papers and all the information coming out was saying property prices are rocketed up. That's ironically what amateur investors do. They don't look long term. They look at the short term. They read the news. Everything's going well, and that's when they buy. So we've got some investors who have waited 5, 6, 7 years to buy a property. And then ironically, they've bought in 2021, which is pretty much, into 2021, roughly the height of where it's at. They could have bought pre-Brexit, Brexit, COVID, all those opportunities were missed. So this is why we always say to people, forget about the daily news. It's not about the daily news. It's about long-term while you're buying. So many people have made mistakes by looking at these fashions, and fashions at the time during COVID were need for space. Didn't last. A year and a half later, we're sitting here now. City centres are more popular than ever. Flats are increasing in price. 1 beds more than 2 beds, ironically, because of the crisis in terms of the energy bills and things like that, cost of living. But if you get a 1 or a 2 bed, again, you're still going to have a city centre apartment, which is long term far better than something on the outskirts. And increasingly as well, there are a number of other things that were predicted. We mentioned to people, again, rental increases. As the property prices increase, people rent for longer. Recession as well. A lot of people saying, well, what if there's a recession? People can't afford to rent. No, that's not what happens. When there is a recession, people don't buy. They actually rent for longer. So again, helping people, helping landlords out, helping investors out. And a lot of the times we've got properties that have increased rental wise from, we've got £160,000 1 bed in Manchester. The rent at the time was £750. They're now charging £1,200 for that same property 2 years later. That's a dramatic increase in terms of your rent. So again, a lot of the predictions we got correct. Price increases, we actually said 6%. Now, we thought we were going to be way off with this because halfway through the year, we were kind of already there. We thought, well, we might be another double-digit year. But we said 6%, and what's actually happened is prices in the last month or so have sort of pulled back a little bit. So it looks like we are going to finish the end of the year around about anywhere between 5.5% to 6.5%. So we're going to be pretty much bang on with our prediction at the start of the year. Now, we're going to look at how the market's finishing up as well. So this is something that I wanted to put into the webinar. So what we've actually done is, we started in the same vein, as I say, 2021. It went like a steam train, but it changed dramatically as the year went by. And what I've done here is there's 2 figures. On the left hand, you got the month, of course, and then on the left hand side, that's what's called the year-on-year figure. So that's from January 2021 to January 2022. That's what it increased by, 11.2%. And the 0.8% is what it went up in that 1 month alone. So as you can see, as we head through the months, it was tracking double digits. Every single month, we were double digits that if you bought in 2021, you'd have been over 10%, 11%, 12% up year on year. And every single month, you made 0.8% in January, 1.7% in February. And again, it continues. March was a great year. Again, it was tracking nearly 15% up year on year and over 2% for the month. And things kept continuing. April was a bit of a lull month, but again, it started to get a spur on back in May when the weather picks up. Is always the same in this industry. And then people started to feel a bit of a squeeze. We got to sort of June, July time. Now that's typically a time when people go away. So you do start to see a little bit of a static market. And you can see that represented in what happened month on month. It was only 0.3% in June and 0.1% in July. But then, of course, people started to notice inflation. August, 0.8%. And then, of course, we had the mini budget. September was absolutely static. We still sold a lot of properties, but the prices didn't increase. But that's, some people look at that as a negative, but take it as a good thing. It means that actually, if you were looking in September and you weren't going to buy till November, December, you wouldn't have actually had to pay any more for your property. And of course, in October, we saw that there was a dip in October. That was after the mini budget and, of course, the crisis with the mortgages, where most people had mortgages pulled from them. As mortgages started coming back to the market, we got into November, but the damage was already done, and we actually saw a 1.4% dip according to Nationwide in November. We're yet to see the full figures for December. There's predictions of around about, let's go back to that, there's figures of around about -1 to -1.5. But as I say, we expect roughly around about a 3 to 3.5% fall over the last sort of few months. But actually, if you just take that, that 3.5% fall, so let's say December does fall by, approximately 1%, 1.5%, and we see 3.5%. Well, actually, that's only kind of taking us back to prices where they were earlier this year, March. A lot of people are saying, well, if it crashes by 9%, 9% certainly won't be a crash. 9% will be a correction. So you've got the Office of Borrowing Responsibility. They're saying it's actually going to be a 9% dip in the property market. But most people are saying, well, if it crashes 9%, but that, I promise you guys, that is not a crash. If you look at what's happened at the start of this year, and you look at these figures, we're sort of 2.5% here, 4%, roughly 5%, 6%. You're probably only talking about taking out in the region of 12 months to 14 months worth of gains that have happened in the last last couple of years or so. So we're not actually too far away from where we were. We're just back to 2021 prices. A crash would take 5 years off the market. We're back to 2017, 18 prices. That was what a crash would be. We certainly don't think that's going to happen. We can see corrections, but again, use it to your advantage. We're saying to people, especially investors, if you've got a property price that's 160, we'll go and bid 150 for it. Go and try and get that, 7.5 to 10% off. Go and try and get that discount. And some developers are willing to take that because they're looking at the news, just like you guys are. And they're willing to think, well, okay, I might not sell this for another couple of months. Let's just, take the offer while it's there. So it's actually, ironically, a great time. That the negative news, it's the same with the stock market. When the stock market falls, you don't want to get out. That's actually, ironically, when you want to get in. So there's some great bargains to be had now. So I'd certainly be using this to your advantage. And of course, as we sort of head back to the screen share here, we can see our views of the market in 2023. We think that we're going to have a slight correction. We don't think there's going to be a crash. We've been saying this all along. We certainly don't think there's going to be, 15 to 20% crash. We always say that the property, the best time to buy in the property is always, in the past, because the reality is that very rarely have you had a time when you could say, no, it's going to be better in 6 months because of the crash. It's going to be better in 12 months. Because the advantage of property is, even if you see, let's say we see a 10% dip over the next 18 months, because property doesn't fall in a straight line. We're already seeing there that we've had a 0.9% dip or 1.5% dip. It doesn't fall in a straight line over a 1 month period. It might take 18 months to correct. But during those 18 months, if you dip 9% or 10%, we could probably make you 15% in terms of your income. So ironically, you'd probably still be better off. So that's why typically, if you go back in time and say, well, maybe I should have bought in that period, even in 2008, just before the major crash, you could have actually still benefited from buying in 2008 because you'd have had 2 years worth of income. And the reality is it took 2 years for the market to reach that trough and then start to head up again. So you can easily make that money back in terms of your income. So as I say, we expect there to be a correction, a slight correction, certainly not a crash. The mortgage rates, we've got far more confidence than we had in 2008, 2010. Why? A lot of reasons. First of all, is we're nowhere near the kind of mortgage rates that we were in at the time. Liquidity is much better this time with banks, so banks are more willing to lend, whereas in 2008, you saw people queuing up outside the bank to get their money out, and because liquidity just simply wasn't there. We don't have that this time around. And of course, stress tests have been done to pretty high levels, mortgage rates up to 7.5%. That's a high stress test level. So we're not at that stage yet. We don't think we're going to get there either. So the reality is we feel a lot better and a lot safer this time around than what we were back in 2008. And of course, the rental market is extremely strong. We know that the rental market's there. We do a huge number of lettings outside. And I'll be honest, it's an easy business at the moment, because the moment we put it online, it gets marketed. Within 24 hours, we've got enough people to have 2 days worth of viewings, and at least a handful of those will make an offer. And again, you can see here that, you know, this is city centres that are looking to perform and what they're looking to do over the next few years. This is not our chart. This is independent accumulation of independent figures here. You can see that as we look from the cumulative total on the right-hand side from 2023 to 2027, you can see that you've got Bristol at 18.2%, Birmingham 19%, Manchester 21%. All of these cities over the next 5 years are looking to still perform extremely strong in terms of the rental market. So, you know, if you buy something now and you hold it for 5 years, you're going to get a 21% increase on your rental market, which is half the reason why you're buying this, is to get regular income. And again, we go back to the tips, because this is the biggest thing that we say to people. You know, finding the property for you guys is easy. That's the reality. Finding a property for any investor is easy. Renting it out is easy. Getting it furnished is easy. Honestly, guys, that's the easy bit. The hardest bit from us is convincing people that actually they should still buy because they read daily news. The easy bit for us is convincing people in what they call like a bull market, in a property market that's going up in a straight line. It's easy. Everyone wants to buy. The papers do the jobs for us. But ironically, that's when it's tougher to get a discount. When everyone's buying, it's hard for you guys to come along. If you've got a property that's 300 grand and it's going to sell within the next week, you can't go to that developer and say, I'll give you 270, 280 for it. Whereas ironically, now that there's negative news, that's when you can go and get the discount. So actually, it's better to buy now. You've got more chance of getting a discount now than you would have had 8 to 12 months ago, because everything was selling within days. So the reality is it's trying to convince people when they should actually go in, and you should actually go in to buy in the tough times, because that's when you actually get the best deals. So as we head back, there's another couple of tips that we can give you guys as well. You've got to speak to a professional that's in the industry. You would never do this with anything else. You wouldn't go and the analogy I always give is, you wouldn't go and plumb the house yourself. You wouldn't go and put the electric wiring in your house yourself if you didn't know what you were doing. Investing is a professional business. That's why there are professional people that are accountants, advisors, stockbrokers, property brokers, right the way through. There's a lot of things that we know that a typical amateur investor won't know just from looking on Rightmove, for example. You can start your information and your research on Rightmove, but there are certain things that we do. We speak to councils. We know exactly what's coming up. We know the regen areas, what's being spent, what's needed in those areas, where the tram stops, the train stops are all going to be. And that's, again, why you need to speak to a professional broker. Whether you use us or another company, there are a lot of great companies out there, guys. It doesn't have to be us. But the reality is, speak to someone who's professional, been there before, and formulate a plan. Don't just say, well, I'm going to buy a property. Formulate a plan. How long are you going to hold it for? 5 years, 10 years? What are you going to be doing with it? Are you going to sell it? Are you going to, what are you going to do with the income? Are you going to keep it within a company wrapper? Are you going to take it personally? Because then we've got to think about tax. All of these things need to be planned for. Importantly as well, look at historical pricing, what's happened in the past. Look at when it did fall in 2008, 2010. It took over 18 months to fall. And it wasn't an overnight sensation that it fell. So the reality is if it took 18 months to fall, what could you have been doing during that 18 months? Well, if you invested, the reality is you're going to be making rental income. And if you've got 50,000 and you're going to go and get a mortgage for 150, so you've got 200,000 overall, that extra 150,000, if you're paying 6% mortgage on it, for example, but actually your rent is 6%. Okay, you're breaking even on that side of things, but your growth might be over a 10-year period, might be 60, 70%. Therefore, actually on that 150, you've got 70% worth of growth over a 10-year period as well. Importantly as well, have it managed. This is the biggest mistake people make, is they try and save what actually amounts to a coffee a day. You know, people go to Starbucks, Costa, Pret on a daily basis. The reality is stop doing that. Pay for someone to manage your property, and you'll have no stress. We get calls all times of day, weekends, night, and again, we had one a couple of Sundays ago where the boiler didn't work, so we're phoning them up. We're looking at instructions. The last thing you want to be doing on a Sunday night is look at a boiler instructions manual. Get someone to fully manage it for you. We had an incident in a property recently where we had to remove the tenants. Again, you don't want to be involved in that. That's why for a couple of quid a day, that's all it is. Have it fully managed as well. And ensure that you purchase in up and coming areas. A lot of people come in and they say they want London, they want Canary Wharf. Great, Canary Wharf is stunning. But why pay 800,000 for something and £80,000 stamp duty and rent it out and get 3% on it? Doesn't make sense. You should buy 4 properties in Manchester for 200,000 each. Bring your stamp duty bill down to 7,500 a property, give or take, so 30,000 rather than the 80. So you've saved roughly 50,000 on stamp. and you're going to be getting 6 to 7% on a traditional let, or maybe even 10% on a short-term let. It's far better than to look at these up-and-coming areas rather than the ones that have already made it. And remember, it's an investment. You're not going to be living in it. Doesn't matter that it's close to you. Doesn't matter that it's made of glass, brick, whatever it's made by. The reality is, does it work from an investment perspective? And does it give you what your goals are? Set your goals at the start, whether they're for your kids' university fund, education, your pension fund, your holiday fund, whatever it may be. That's your goals. Does the property allow you to achieve your goals? If it does, what it looks like is absolutely irrelevant, and where it is absolutely irrelevant as well. So look, guys, again, it's going to be the last webinar of the year. We're going to do lots of exciting webinars next year. We've got some podcasts happening as well with some people that you're going to know as well. There's going to be some celebrities on it, again, how they made their money, how they invested. So it's going to be an exciting time over the next 12 months or so into 2023. I'm going to hand over to you guys now. You should have questions, speech bubbles at the bottom. You can ask any questions at all. So let's head in. Let's have a look. So we've got some questions here. It's a good question. Here's first question came up. Has the gap on the yield between the long-term rental and the short-term narrowed? That's a really good question. It's not really. The short-term rentals has always been really lucrative. However, the reason why it's narrowed isn't because what the money that you're getting in, it's actually what's going out. So on these short-term lets, what we're noticing now is things like cleaning costs are increasing. Whereas before, you would have had a cleaner for, let's say in Manchester, £10 an hour. You'd have had to get 2 hours and cleaning of your sheets on a single bed, and that would have cost maybe £40. We're now noticing that everything's gone up to £65. So you might think, well, that's only £25 difference. But the reality is if you have 10 lets a month, well, that's another £250 that you've got to actually cut, that's going to come out of your short-term let income. Now, we have bumped the prices up of the short-term let, and as I say, they have come closer together, but they're still far enough apart to make short-term lets worth doing. So we think sort of 5–6% on a traditional let, but as I say, we still comfortably feel that you're talking double-digit returns net on a short-term let. So it's narrowed slightly, but it's not to do with what you're getting in; it's to do with the actual costs that are associated with a short-term let. What's your overview of Liverpool as an investment area where I already have a buy-to-let? Liverpool's great. Liverpool's a really good area for buy-to-let. However, there has been problems in Liverpool. We're not, and we're not immune to those problems either. There's a number of companies that have been really frustrated with the developers in Liverpool and their attitude to developing. There's been delays. There's been issues with the council. The council actually had to be removed and replaced by the government because they were so poor in terms of performance. They were taking backhanders. It was something like out of a third world country. They were taking backhanders. You had the mayor who I think he got arrested or something like that. So not to alarm anyone, but we are really meticulous now with what we move with in Liverpool, because the reality is there's been so many horror stories about things that have been done. And, the mentality in Liverpool was see how it goes. Whereas the mentality in Manchester was very much like London. We're going to get this done. We can offer a good service and we're going to make it work. Whereas in Liverpool is, yeah, you know what, we'll see how it goes. If it works, it works. If it doesn't, it doesn't. And that's been really poor. And it's been hugely frustrating for companies like us who know Liverpool got this great opportunity. Especially they've got the new Liverpool Water scheme down there, and they just haven't quite grasped that they need a professional run outfit. But we're hoping that things are starting to change as we have more and more big developers go up there because they're realizing the opportunity. We've got one at the moment with Liverpool Waters up there. They're realizing there's great opportunity up there. And the reality is that they've just changed the council. Next question here. Is Manchester still making as much money as you quoted in terms of the rentals? Yeah, it is. Manchester, the majority of outlets actually are in Manchester. And every time one comes back on, we actually would love to do 6-month rents, because if we do 6-month rents, we could put the rentals up every 6 months. But most people want to sign a 12-month contract. The reality is that we had, say, the one that moved out was 1,150. I think we just added 10% to it straight away and it got snapped up. We could have probably added 20 or even 25% to it. So yeah, Manchester is still great. Of course, prices have increased there. We're not back where we were getting 80 to 100,000 pound one beds back in 2012, 13. We're nowhere near that level. You're talking more than double that now. But the reality is that the rental market's still there. The short-term let's phenomenal. We've got people on short-term let who are making 12 to 14% gross income, netting sort of 10% returns on a net basis. So yeah, Manchester's still a great opportunity. along with all of the northern cities, really. I say Leeds is still fantastic. Leeds is harder to come by, but there's some opportunities that are coming up in Leeds. Leeds is a great city. Sheffield recently we've had, that's been fantastic. So yeah, sticking to those cities, we're still confident that that's the way forward. Next question here. Why don't you think the property market is going to fall by 30%? It's pretty easy to answer because it never has. That's the first thing. Why would it? You're talking about 50% of the world's wealth is in property. It just doesn't happen. You know, we're not talking about countries where you've got hyperinflation or anything like that. We've got high inflation. It's not hyperinflation. They're going to curb it. So they're going to concentrate on core inflation. They're going to curb it with interest rates that they're hiking at the moment. But don't forget that the government need property to work. Property, you know, the cycle of properties, people buying and selling properties puts a huge amount of money in the government's coffers. Why? Because of stamp duty and all the people that are involved. You've got stamp duty, first of all, that's a huge tax that goes into the coffers. Every time a property is bought and sold, it's stamp duty. Then on top of that, you've got the house building market. Again, they pay a huge amount of tax. Then, of course, you've got estate agents, tax from them. Then you've got lawyers, mortgage brokers. There's a huge amount of people that feed into this industry. They don't want to ruin it. So that's why that there really is a fine line between putting the rates up too much and actually causing issues with the property market, sending people into negative equity, causing a recession, and sort of, you know, trying to curb inflation. They would probably rather let inflation run a little bit hotter than normal to keep that property market going. So the chance of it falling 30%, no. Also, along with that is the stress testing, as I mentioned, that they've been done. We're not in 2008 times, whereas back in mid-2000s, you could self-certify, walk into a bank, tell them how much you made as a self-employed individual and get a mortgage on the back of it. You've got no chance of doing that now, you know, whereas before it's 3 months, now people are looking at 6 month statements. They're meticulously going through, even to the point of parking tickets. If you've got X amount of parking tickets, they think you're probably going to be an unreliable person. So people who've got parking tickets are being turned away for mortgages. Other things as well. A colleague of mine in here, he likes to have a little bet every now and again on the horses. He's got an account with Betfair. So they asked him, well, what's this money going into Betfair? And they on the back of that, one company said, we're not going to give a mortgage to you. So he said, why? He said, well, we think you might have a gambling problem. And we're talking about small money. We're talking about a few £100s every now and again going in. But because it was consistently going in rather than one big lump, they felt that that was more of a problem. So they're so much more stringent now than they were going back sort of 15, 20 years. So that's why we don't think that there's going to be any type of 30% crash. Correction, yes. But look, if the prices have risen 20, 25% in the last couple of years, then in the whole scheme of things, what's 7, 8, 9%? So my advice to people is buy off plan, wait for the mortgages to rates to come back down in 12, 18 months time plus, and also bid on those properties, and we'll go and we'll take that bid to the developer and we'll push as hard as we can for you. Simple as that. So I think that's it, guys. Well, look, have a lovely rest of the year. Have a great rest of 2022, and Merry Christmas and Happy New Year to everyone. And I'm really excited to speak to you guys in 2023 and tell you all about our exciting plans, what we've got to offer, and go from there. I'll take care and I'll see you soon. Bye-bye.